We'll just move forward. So to my immediate left is Trung. Trung is the manager of our VAF portfolio. VAF is a Cayman-listed fund with monthly liquidity that buys our local fund VSAF. Next to him is Nguyen. Mike is the portfolio manager of VVF, which is our Luxembourg domiciled UCITS fund, a daily liquid SFDR Article 8. So first question, which we have rehearsed diligently. So before we get into the fund and the strategy, how long have each of you been investing in Vietnam? What's your background?
So I graduated in 2006. At that time, the market had only 11 listed companies. At the end of 2006, the market had around 90 companies because the state subsidized the tax for all the listed companies to push them to the stock exchange. So that triggered me to create an excitement for me. I was in Singapore at that time, and I returned to Vietnam in 2007. I have been covering the Vietnam market ever since on both buy side, sell side, as well as a global bank. So besides Vietnam, I also look at several other Asian markets in the past. But Vietnam has always been my core coverage over the past 18 years.
So how long have you been a fund manager?
So I have been managing the UCITS fund for the last 5 years. Before that, I was investment analyst for Franklin Templeton for around 10 years, looking at Asian markets.
And Trung, how about you?
So I returned to Vietnam in 2011, about 13 years ago. And back then, we had the second time in Vietnam where we had hyperinflation within 3 years. So that was a remarkable year. Back then when I returned to Vietnam, lots of challenges. But thankfully, I've been helping investors invest in Vietnam since then. And along the journey, I've been on the sell side and the buy side both. But along the journey, lots of lessons learned, lots of time helping investors invest in Vietnam. So I joined VinaCapital about 3 years ago, 2021. And prior to that, I spent about 2 years with a Singapore-based hedge fund.
And so importantly, and I'll just, Mike, I'll ask you this question. So for international investors, once the allocation decision is made, oftentimes the next decision is to be active or passive. What's your perspective on active versus passive in Vietnam?
If you see the performance of the active versus passive funds over the past 1 year, 3 years, 5 years, you see the large outperformance of the active funds across the board. And for our funds, we even did better than the market and the peers as a whole. So the number says itself. For us going forward, if you see the way we structure the portfolio, we identify companies with higher growth than the market and at lower valuations. So we hope that if the market behaves rationally, probably in the long term, we'll outperform the market.
And just, we showed this earlier in the panel with Tu and Lin, but this is the performance for VVF, which is Mike's portfolio, and VAF, which is Trung's portfolio. So certainly when you kind of discuss that whole active-passive thing, it usually doesn't, well, this is not a market where cheap beta works. And so in certain markets, the US, you can make the case that cheap beta makes sense. I think if you look at the performance, both of these portfolios, the outperformance is consistent. And as Tu mentioned, it's been in both up markets and in down markets. You know, in addition, when people think about active or passive, then they say active, oftentimes then people start looking at cap. Do you have a perspective, Trung, on investing by cap, whether it's large cap or mid cap? Do you have a target, or is this really a result of stock selection or sector selection?
Right, so VAF is a mid-cap mandated fund, so obviously we have a strong focus on mid-cap. But more importantly, we have a team, we have mentioned several times during the conference, that we have a team of investment and research professionals working hard on a weekly basis, trying to uncover gems in the mid-cap space. So we have a team capable of uncovering investment opportunities in this particular space. So yes, for this particular fund, we have a strong focus on mid-cap, and we have been, I would say, pretty successful so far.
And Mike, how about you?
The size of the investment will depend on the aspiration of the fund, how big you want the fund to be. So for example, for us, if you see the fund size of VVF is around $100 million, but we aim to grow it to $300 to $500 million in the next few years. And the way we structure the fund is we select the companies that is suitable for the $300 to $500 million in AUM. So if we reach that kind of target in the next few years, we don't think the components of our fund will change that much. We don't want to give an investor a surprise on the different portfolio if you change the AUM of the fund. That is what we aim to do.
Okay, thank you. And so as we think about it, and we're showing the top 10 for each of these portfolios, you know, we look at your funds, the active share is quite high. I think it's around 70 for you and around maybe even 75 for nearly 80%. Is that something that you target, or is that just a result of the bottom-up stock selection?
It's a result of the bottom-up stock picking. And I think Mike will agree with me on this. We each have a set of companies that we have been knowing very well over the course of our experience working in Vietnam and helping investors invest in Vietnam. We have a set of companies that we believe we have an edge in knowing them much better than the market. And then we play around with this list of high conviction ideas. And as a result, we basically manage portfolios with very high active share. So that's a result of us bottom-up picking, stock picking, the high quality companies.
So active share is never a target we want to achieve. It's consequences. If we see good investment in blue chip companies, probably we will take it. We will go for the blue chip names, and active share numbers will reduce. But for us, we run a very concentrated portfolio of the company that we can understand. So we think that the positions of around 15 to 20 companies are sufficient for diversification purpose, and we do not need to go much beyond that level.
So how many companies do you own today?
Currently, we own around 24 companies for UCITS portfolio. But if you see the top 10, we think we run the most concentrated portfolio among the UCITS space, around 60% plus on average.
62.
Yeah.
How about you? How many holdings?
About 25. And just want to add one point to Mike's point earlier. ACB is now a blue chip company. It used to be a mid-cap company. Now it's a 4 billion blue chip company. Just because it's a blue chip company doesn't mean it's not a good investment, and doesn't mean it's not going to yield you very high return. So ACB is a case in point. Very good company, very undemanding valuation. Yeah. So it doesn't have to have anything to do with market cap.
Well, and it is interesting because we showed the slide earlier that showed holdings by cap range, and we had a question from a client once that asked us because our large cap exposure had increased, and it was simply because I think as mobile world actually rebounded, and it used to be mid and then it became large. Is that correct? If I'm remembering that correctly.
That's correct. Normally you see our top conviction names have better performance than the rest. And you will continue to see a higher concentration in the bigger names because the priority for us is to choose the better one on top.
So interestingly, and I think this is a really important concept for everybody, for each of you. So you run concentrated portfolios. You have high conviction ideas. How do you manage risk?
For us, when we invest in any company, we divide two types of risk. The first one is operational risk. Operational risk here is how the company has been running, how is the cash flow, leverage, and the correlation with other names. The second risk is valuation risk. Valuation risk here means the entry level that you pay for the stock when you enter into a position. If the valuation is low enough, probably your downside risk will be reduced. But if you pay a high price, your risk will be much higher. So we divide into two types of risk for us to see how we should react to different situations.
I just want to add that Mike's answer on operational risk and valuation risk basically covers 80 or 90% of the risk management that we do already. So I'm just going to add the remaining 10 or 20%. Even though we run highly concentrated portfolios, on top of the valuation risk and the operation risk that we review constantly, at the portfolio level, we also look at whether we're overexposed to certain sectors, especially sectors that are macro sensitive. If we are looking at the macro environment turning next year, for example, we want to be mindful of sectors that are exposed to that. So that's the portfolio level. We also have a risk management, portfolio risk management team that helps us review risk metrics on a monthly basis as well. There you go, that's the remaining 10 or 20%. But this is the 80 or 90% of the work that we do on risk management.
Right. So a question just came in for you. So VAF is a feeder into VSAF, which is a local fund. 90% is VSAF. Why not 100%, or what is that other 10% allocated to?
Right, so actually it's about 95-ish% into VSAF. And yes, we have the flexibility to invest 100% into VSAF. Occasionally we find high conviction ideas that either we want to add on to the existing VSAF exposure to have an even higher exposure to that particular name, or we want to take a longer term view, because for VAF, which is a feeder fund, we can afford to take a longer term view, whereas for VSAF we have to take into account daily liquidity and things like that. And so that remaining 5%, which is very small anyway, it's just an added flexibility added on top of the VSAF.
Yeah,
but
right.
keep it in mind, we can.
So historically, I've seen VAF own some more illiquid names that might not fit into VSAF or may need to be sold, or again, you've overweighted things that maybe were beyond the 15%, correct? Okay. All right. Okay, so here's what I'd ask each of you to do, and I'm going to give the remote to you. So we've got the top 10 holdings for each of them, and you obviously see a fair amount of overlap. Would each of you walk us through a company, the top 10, that's a good example of your investment philosophy? We're going to find out together. Don't go the other way.
Sorry about that.
I'm going to take this away from you. Okay.
Right, so this is that's my company, yeah. So this is Gemadep, which is the best-in-class seaport operator in Vietnam. Let's take a look at the big picture first and see why we are interested in this particular sector in the first place, and within this sector, why this company to begin with. So in the morning, Mr. Khanh has mentioned that trade was a game changer for Vietnam. And fast forward to today, if you look at Vietnam, you look at an open, export-oriented growth economy. And much of the growth comes from export. So if we want to look at a quintessential growth metric that captures this would be the container port traffic going into Vietnam and outside of Vietnam. That's basically capturing the export-oriented growth story in Vietnam. So if you look at the container port traffic here on the first chart on the left, it's been growing at about 7%, which is slightly higher than real GDP growth for the past couple of years. And even the growth this year has been even higher, rebounding from the low base last year. This is the quintessential growth metric when I look at Vietnam. Now look at the second chart on the right-hand side. Within this sector, we want to be exposed to this sector because it's the growth story of Vietnam. Within this sector, we want to look at a company that has been growing market share consistently over the past few years. And this is important because by growing market share, a couple of things have to happen. One, the company has to add capacity, which is very difficult in this industry alongside other industries as well. adding capacity is already very difficult to begin with. They have to navigate the local regulation. They have to navigate capital adequacy and things like that. Number two, after adding capacity, they will have to utilize the new capacity, bring in new clients, and gain market share from other competitors. Otherwise, building new capacity just means, and if you're not getting clients coming in, you will just have a bunch of unused capacity. So the second thing is they will have to utilize the new capacity. And the third thing is that by gaining market share, the thing is the export growth story for Vietnam would not be rosy every year. There will be years where we have a slight slowdown. For example, next year, our chief economist has already mentioned that we will not have electronics growing 20 or 30% like we saw this year. So there are some years where the pie is not growing that fast, and we want the company to be gaining market share so that they can grow their earnings even though the pie is not growing that fast. So this is why the second chart is very important. And so this company has been growing this market share very, very nicely over the past few years. Now let's take a look at, I need a tutorial on how to do this. Obviously, I'm not very good at this. Right. So we take a look at why this company has been gaining market share. We ask a lot of why questions. And number one, the business model makes sense. Right? They have been choosing strategically located assets, very difficult for competitors to replicate. And the capacity that they have been choosing is sizable. They can accommodate larger vessels than competitors. So, you know, the clients will say, oh, this port has enough capacity for us to go in, let's go in this port. And the competitors will not be able to do that. So the business model makes sense. That's why they get in the clients, right? And the second...
So understanding that, how does this represent your investment philosophy specifically?
Right, so this philosophy we are talking about within the context of Vietnam is very growth-oriented, although we take valuation very seriously. Now, how does this relate to that philosophy? We want to see companies that can scale up and gain market share because we basically are looking for growth. So having the right business model means you can not only scale up, you can also defend your market share as well. And that's why choosing the right business model is very important, and that's why it's related to the philosophy in the first place.
So it's growth, but it also has high barriers to entry, has competitive advantage, excellent management team.
Yes. Okay. So high entry barriers to defend your market share and the right business model for the clients to come in and use your products and services. So point number one is business model. Point number two is management. Very important. You know, you can have very well located ports, but you know, have lousy management teams running the ports. You're not going to have, we've seen that a lot. You're not going to have market share gains. You're going to have market share losses over the years. So this management team has been very good at allocating capital, not just operating and managing, and also allocating capital as well. And last one, it's the growth potential. Doubling capacity and potential to increase fees.
All right. So Mike, same question to you, and we're going to go, I guess, to mobile world.
Yeah, actually last year I presented more Shibadep as well, so we had the same kind of talk. So Mobile World emerged as our largest holding for this year due to capital appreciation as well as additional purchase from outside. Just very briefly on the company, is the largest retailer in Vietnam with around $5 billion in revenue. 2/3 come from the phone chains and the consumer electronic chain, and around 1/4 come from the new grocery business. So if you see the ICT chain, phone chain and consumer electronics, the market has been kind of mature. They account for around 30 to 40% market share. So the growth opportunity is not there. What keeps the company moving forward? What we bet on is the growth of the grocery chain. Currently, they have around 1,700 stores. Many lessons for them in the past because they started the business in 2015, 2016, and they incur around $350 million in loss over the past 8 years. It's a huge lesson for them. Um, on this chart, we want to show how we think over the years, how we change the positions, adding the name over the years. Before COVID, we didn't have a position. There are two reasons. The first one is on the company has foreign ownership limit. And up to a point, we have to pay up to 40% in premium to acquire the shares. We didn't want to pay that. The second is we think the market didn't factor in the ESOP expense. That accounts for around 1/3 of the net profit of the company. So instead of 20 times PE, actually the true valuation should be around 30 times PE. We think it's too high. We didn't buy in. So when COVID happened, normally the risk comes with opportunity. You see lots of foreigners outflows during the COVID time, and we didn't have to pay premium to acquire the shares for Mobile World. In addition, the macro environment was favorable. You have work at home conditions for people, and you have supply disruption. So the company recorded significant profit in those 2 years, in two COVID years. And we entered the position at that time. When we enter, the valuation of the company is around $2.5 billion. We understand that under normal circumstances, the company makes around $200 to $300 billion on the consumer electronics and phone alone. That excludes the grocery business. The grocery business is for free. So we enter in that kind of valuation multiple, 12 times PE. But when COVID finished, we think that kind of margin the company earned during those times could not sustain. It was around 7 to 8% net margin on ICT and mobile phone. It was not sustainable. We think the profit will be reduced, and we trim down our position accordingly. So opportunity turned again in second half of 2023. The trigger point at this time is we see the grocery business, same per store sale, has picked up quite nicely from around $50,000 to around $70,000 on monthly basis. The grocery business could stand on its own without funding from the parent company. So cash flow is positive. We think it's the inflection point. And valuation, again, come back to the $2.5 billion. So we see certain level of downside protection here from the recurring income from ICT and phone chain. But we have the upside from the grocery business. That make our decision to enter the position in a big way. And we increase the position even up to nearly 10%, which is the limit of the fund. Yeah. So far for this year, we have been doing very well.
Okay, terrific. Thank you. So, as we think back to what we talked about earlier this morning, a lot of the conversation is about FDI, about manufacturing and exports. Some of the questions that we get are, well, okay, that's great that Samsung has invested $21 billion or that Lego is building a $1 billion facility. Do all of those profits go to overseas companies? And so if you're only investing in Vietnam, how do you think about investing in the trends like FDI, exports? How do you do that with essentially a fund that just invests in Vietnam? How do you take advantage of those big trends?
Let me take this question first. There are two parts to the answer to that question. One is that certainly at VAF, we prefer companies that provide the essential infrastructure for FDI to operate in the first place. So we're looking at industrial parks, we're looking at telecom infrastructure, we look at energy infrastructure, etc. The essential infrastructure for FDI companies to operate. And so that's where we invest first. Another way to play with this theme is when FDI comes in, we can also invest in companies that will indirectly benefit from that. When farmers work from doing farming to being workers in the factories, they will spend more. Mobile World could benefit. For example, that's an example that we can look at. We don't have to be just looking at the direct beneficiaries.
But what about any specific themes?
In terms of thematics, yes. If you look at the screen here, we're actually quite similar, almost exactly similar. Yes, so in terms of themes, if you look at themes here, we have two big themes basically: the export/FDI is this one big theme, and then domestic consumption is another big theme. Depending on the years, I would say probably next year we will be looking at domestic consumption more. This has been a recurring theme so far in this conference. So, the short answer is that we will not be just looking at FDI as the main theme in every year. You know, it depends on of course, the valuation and the way we assess the companies on a bottom-up basis.
Mike, how do you think about this?
Unfortunately, we could not identify the companies in manufacturing sector that related to FDI exports. But we get indirect exposure through like port operator, we both have German debt. We have investment in the industrial park developers, which provide the land to the FDI companies. So those are the positions that we have that can benefit from the FDI companies.
Okay, all right. So we have a few minutes left, so I'll ask each of you, I guess, one final question. So, Mike, I'll start with you. So you've each been investing in Vietnam for over a decade. What has been the most important lesson that you've learned, and how is that impacting you now in terms of how you manage the fund?
Yep. We have been passing through many cycles for the market. We are still learning and refining our investment process. We haven't been able to reach the level that we want to be yet at this moment, so it's still a learning process for us. But what we want to convey to investors is, normally we only invest in companies that we understand, and we can explain to you in a common sense. We think for long term, but we must have a sufficient level of qualitative assessment to decide on what to invest in. Humility and willing to learn are obviously very important to this market, because the market can have many surprises that we didn't think it exists before we make the decision. So keep learning and willing to learn.
I can tell you that it's very difficult to single out the most important lessons. There are a lot of important lessons, and we've been humble enough after a decade or more helping investors invest in Vietnam. But I can certainly give a couple of examples, specific examples. Or just one, or probably two actually. A couple of keywords that actually have been mentioned throughout the conference before. Keyword number one is channel checks. Why it's important elsewhere, not just in Vietnam. Within the context of Vietnam, the very particular context of Vietnam, channel checks is super important. We have a country with Hanoi and Ho Chi Minh City sitting at both ends of the country, developing rapidly, but with very different dynamics. So we sitting here in Ho Chi Minh City, we will not be able to understand what's going on in a real estate project in Hanoi, for example. So, or conversely, someone sitting in Hanoi will not be able to do the store visits in Ho Chi Minh. So that's essential to the investment process. And probably another keyword that I would mention is teamwork. It's also essential to leverage teamwork. Vietnam is developing very fast, and no one is, knowledgeable of all the sectors. I'm very humble to learn from my teammates. I have been shamelessly borrowing ideas from my teammates. I'm proud of that. And even for sectors that we have been having some experience in overseas markets, when we bring back to Vietnam, there's a lot to learn. I have looked at banks in other countries, developers in other countries, but when I look at banks in Vietnam and developers in Vietnam, there are certain aspects that I find myself learning from scratch. So that's my answer to that.
So, learning never stops. All right. Well, I just want to say to Trung and to Mike, thank you so much. If you look at the performance, they've both done an incredible job, and I appreciate the level of humility, because learning certainly does not stop. So just give us a warm thank you to the performance that these guys have been able to generate. So thank you so much.
Thank you.